Hi everyone, I am Ankit Khalane. I am an equity research analyst, and today we will be discussing about one of the company who came up with an IPO and got demerged from its parent company. I am talking about Siemens Energy. So our main focus on this channel would be we are going to read about high growth companies with high ROE, high ROC, low PEG ratio, or someone who is a dominant player in their segment, or someone who is doing something unique and they have a different business model. So today we are going to discuss about Siemens Energy, and we will try to understand that how this company differentiates from the other competitors. So Siemens Energy isn't just a local Indian firm, it's the exclusive South Asia partner of the global Siemens Energy brand, and that means that they have the right to sell, engineer, install and maintain Siemens Energy full portfolio across India like Nepal, Bhutan, Sri Lanka and Maldives. So their portfolio is actually very vast, like it includes product solutions, services, then support customers. So they have the entire value chain from the generation to the transmission and to digital optimization. And do you know what is their ultimate goal? So their ultimate goal is to help clients from transitioning to cleaner energy and to hit the net zero targets. So now let's take a quick look at the shareholding pattern. So currently promoters have 75% of the holding, which is a good sign. When we are analyzing any company, we need high promoter stake. So that means they have the skin in the game and we can trust the promoters. And if you look at their FII holdings, it is currently 8.42%. DII holding is 6.9%, and the only DIIs are HDFC pension fund, and rest of the holding is with public. And in the coming future we can also see that it might happen where FIIs might buy more from the public or DIIs might buy more from the public if the company does good in the coming future. So let's see going forward. So now the next question is, we should try to understand that where is the technology actually used. So the answer for this question is, it's not just in power plants. Like Siemens Energy provides solution for electrification, automation and digitalization in a wide range of industries. So the first industry is process industries, where like oil and gas, chemical, petrochemical, paper and even in defense, where they supply systems for submarines and naval vessels. So their technology touches everything from industrial manufacturing to the national security. So the competitors in the segments are Hitachi, BHEL, GE Vernova and Crompton Greaves. So Hitachi and BHEL, they are both in the HVDC space, whereas Hitachi Energy was earlier known as ABB. It is in the transmission and the grid automation phase. So now if we take a look at the product offerings in this segment, so Siemens Energy and BHEL, they are present in all the offerings, whereas GE Vernova and Hitachi Energy, they don't have presence in industrial steam turbine, industrial generators and turbines, whereas Crompton Greaves, they don't have presence in the digital control solution, the flexible AC transmission system and the HVDC segment. So from this data point, we got to understand that Siemens Energy is already a dominant player in the segment, but this doesn't mean that GE Vernova and Hitachi are not good players. They also have a good presence in this segment. But of course we need to focus more on the companies who are dominant and who are growing much faster than the competitors. So now let's break down their business into two major revenue segments. So their first revenue segment is the power generation segment. So this segment is all about generating electricity through large scale gas and steam turbines, and they serve power utilities to state electricity board. They also serve to independent power producers, EPC players who build power plants and industrial clients who need on-site generation. They also have industrial steam turbines, which is ranging from 10 kilowatt to 250 megawatt, and it is used across a variety of industrial applications. Then they also have transformers. So in transformers, there are also other players like Silchar and Voltam, which are also very good player in this segment. And one of the key differences in the Silchar is that their major revenue also comes from exports. So when you will look at their financials and their margins, they have a little higher margins compared to other players because of this reason. Now let's come back to the Siemens Energy, and they also have reactor and traction transformers, which are used in the railways and metros. And on the solution side, they handle EPC projects and turnkey projects for substations. So the meaning of turnkey project is from the designing part to the maintenance part, they look up to everything. And they also provide other solutions like HVDC solutions using voltage source converter. So now let's try to understand that what is VSC HVDC. So it is used to transmit power over the long distances with minimal losses. So especially it is important when they are integrating renewables or cross-border power exchanges. And interestingly, Siemens Energy has only bidded in the VSC based HVDC. So they have a market cap of approximately 1 lakh crores. So this is a data point which is shared by HDFC Securities. And in FY24, the company had given a revenue of 6,158 crores. But by FY27, the number is expected to come up to almost 10,500 crores. So that is a 70% growth in just 3 years and a CAGR growth of 20%. And it's just not revenue. Even if you look at their EBITDA, which is operating profit, is expected to more than double from 984 crores to 2260 crores. So that is a very great operating leverage the company is expecting from Siemens Energy. And now let's talk about their profit after tax, the money which actually comes to shareholders. So it is expected to grow from 698 crores to 1861 crores by FY27. So that is nearly triple of the FY24 PAT. And guess what? This directly impacts the EPS of the company, which is expected to rise from 19.6 to 52.3. So if someone is holding this company, they can expect that the earnings are expected to more than double. So now we have seen the good and the growing part of the company, but now here it gets interesting. Now if you look at their P, which tells us how the expensive stock is compared to their earnings. Currently their P is 120 in FY24 and they are expecting that the P is going to come down to 45 in FY27. So why are they expecting that the P is going to drop down? So they are expecting that the earnings are going to grow so faster than the stock price, and they have given this forward P of 45. And even if you look at their EV by EBITDA, which is currently 85, is going to go down to 34.7. So that's a very good improvement in valuation HDFC Securities is expecting from this company. And now let's look at the last parameter, which is ROE, and which is a key indicator of efficiency. So in FY24, it started with 10.7% and they are expecting that it is going to go up to 48.9% in FY25, and after that it is expected to cool down around 28.8% in FY27. So FY25 numbers are huge, but it is only because of there is a one-off gain of operating leverage kick in, and then the numbers are going to get stabilized in the coming future. Okay, so now let's talk about the company's strategy and vision they are expecting for the coming future, and this is a really interesting part to focus on. The first point they have discussed is the focus on decarbonization. So after their demerger, they have positioned itself as a partner in India's energy transition, and they are focusing on PEM electrolyzers, which is used in green hydrogen. It is done by dividing hydrogen and oxygen from water, and then they are used in green hydrogen. Second is hydrogen fired gas turbines, and third is the battery storage system. And the best part is that their parent company has already these technologies developed. So that means Siemens Energy just need to deploy them in India. So India is currently having 1.2 lakh crore of HVDC opportunity, and from that we have only seen 25,000 crore awarded so far, which is mostly to Hitachi and BHEL. So that leaves a massive 90,000 crores pipeline, and Siemens Energy could address about 30,000 crores of that to the VSC segment. But here comes one interesting part. Siemens Energy has only bidded in the VSC based HVDC, and they have not bidded in the LCC segment, which is the other type, which makes up to the rest of the 1.2 lakh crores of the market. So the third point they have discussed is the T&D market has grown 2.5x since pre-COVID levels. And before COVID, the Indian-based T&D market was only around 25,000 crores annually. But now, due to the rising demand, supply and the chain disruption which has happened along with the new capex, the market has grown to 30,000 crores per year. And that's just the base, because 20,000 crore per year is added in HVDC, 10,000 crores per year is added in exports, and 10,000 crores per year is added in demand from data centers, grid automation, and from the battery storage. So now we are currently looking at a 60 to 70,000 crore market per year. So this is very huge, and it's all at the very high voltage end, which only a few global players like Siemens Energy can serve very effectively. And now let's come to their fourth point they have mentioned, is the industrial growth via the turbines and the service part. So the company's strength is in the gas and the steam turbines and after sales services for the industrial decarbonization, which gives them steady recurring revenue. And with the current push of the automation and the carbon optimization, these solutions are only becoming more relevant. So these were the main 4 pointers managements are currently focusing for the near-term future. So now let's do a ratio analysis with their competitors. And so first, let's start with the market cap. Currently, Siemens Energy has the highest market cap with around 1 lakh crores. Then there is BHEL, which is 86,000 crores, and Hitachi with 82,000, GE Vernova with 60,000, and Crompton Greaves with 22,000 crores. So clearly, Siemens Energy is leading this market cap segment. If we talk about their ROCE, Siemens Energy has a ROCE of 24.6, but if you look at GE Vernova ROCE, it is almost to 54%. And ROCE tells us that how efficiently a company is using their capital to generate profit. And in this area, GE Vernova is already leading by a very huge margin, but Siemens Energy can still give a very strong ROCE of 24.6, which we saw above, and which is well above the other Indian players we are currently watching. And now if you look at ROE, again, GE Vernova is leading over here with an ROE of 40.34%. And now if we take a look at operating profit margin, Siemens Energy has 38.6%. So here Siemens Energy is leading, and their operating margins are almost double than that of what is GE Vernova is currently having, and it is nearly 10 times of BHEL. So Siemens Energy runs a very efficient and profitable operations, which is also good for us as a retail investor. So this means Siemens Energy runs a very efficient business, and it is also great news for retail investors who are looking to invest in this company. Now if we take a look at debt to equity ratio, this is a very capital intensive industry. Still Siemens Energy has zero debt. So this is a very huge positive sign for this company, and also this is a cash flow generating company. So the risk is already very less in this company. And now if we take a look at the PEG ratio, a lower PEG ratio usually means the stock is fairly valued or very attractive at this current price. So PEG ratio means P divided by the earnings growth expectations. So while GE Vernova is looking very great with a 2.84 of PEG ratio, but Siemens Energy with a PEG ratio of 4 is still looking relatively reasonable compared to other competitors like Hitachi with a 14.7 PEG ratio, Crompton with 17 PEG ratio, and BHEL with a PEG ratio of 8.59. So the summary of this peers valuation is Siemens Energy and GE Vernova. These two are looking very attractive compared to other three competitors. So now after discussing everything good about the company, now let's come down to what are the risks in this company and in the overall industry. So the risks they have mentioned are the policy delays, execution challenges, or reliance of the parent company, and also they are not competing in the LCC HVDC segment we saw earlier, which is also limiting their time of the company. But after looking everything what we have read about this company, it is looking good, and it is also expanding their industrial capabilities. So it is currently in a strong position, we can say that. So thank you for watching this video. If you think this video was helpful, or if I have missed anything, and also what do you think about the company's future and what are your opinions, you can definitely write it down in the comment section. Until then, see you in the next video.